Let's take a look at defining executive employment status. Executive compensation plans are structured to provide favorable tax treatment for both executives and companies. The IRS identifies two groups that influence company policy decisions: highly compensated employees and key employees. These designations are primarily used for applying non-discrimination rules and top-heavy provisions in employer-sponsored benefit plans. Key employees are generally high-level officers, major shareholders, or owners with significant compensation, while highly compensated employees include officers, shareholders, and others with high earnings or family ties. Positions such as CEOs, presidents, vice presidents, and directors often fall into these categories due to their substantial responsibility. Classifications ensure executive compensation complies with tax rules while acknowledging their key organizational role. Non-qualified plans are established to serve employer and employee interests. Non-qualified plans are designed to serve both employers and employees, primarily targeting executives and highly paid professionals. For employers, these plans help attract top talent and encourage long-term retention, while employees benefit from accumulating more retirement savings beyond IRS limits and deferring tax. Companies use non-qualified plans mainly for two objectives: restoring retirement income restricted by qualified plan limits and providing supplemental executive retirement benefits. Restoration plans make up for benefits lost due to IRS caps, while SERPs go further by offering executives significantly higher retirement benefit. Unlike qualified plans, non-qualified plans often fail to meet ERISA standards for coverage, funding, and non-discrimination, which is why they don't receive the same favorable tax treatment. Employers can choose between funding these plans, securing future benefits with trust funds or insurance, or leaving them unfunded, which poses risks to executives if the company faces insolvency. Decisions about funding often depend on competition, corporate culture, and liability management. Non-qualified plans can be categorized into excess benefit plans, which extend existing qualified plans, and SERPs, which provide more generous supplemental benefits. These arrangements highlight the tension between rewarding executives competitively while balancing regulatory restriction and company financial obligation. Non-qualified plans remain a crucial tool for companies to secure and reward their leadership team. Funding mechanisms provide the financial resources for funded or unfunded plans. Unfunded options, such as the general asset approach or corporate-owned life insurance, provide the least protection since assets may be lost to creditors in bankruptcy. Split dollar life insurance, rabbi trusts, and secular trusts offer increasing levels of security, with secular trusts protecting assets from creditors and meeting ERISA provisions. Employee-owned annuities provide the highest security, as executives directly own the annuity contracts with third-party vendors. Tax obligations differ between funded and unfunded plans. Executives in funded plans generally pay taxes annually on contributions and earnings, while in unfunded plans, taxes are due when benefits are received. Employers typically pay taxes when executives receive distribution. These mechanisms balance employer flexibility with executive security, making the choice of funding approach critical for both parties. Company stock represents equity, that is, ownership interest in a company. Stock and stock option plans are key tools for executive compensation, providing both ownership opportunity and financial incentive. Incentive stock options allow executives to buy company stock at a predetermined price, often leading to significant gains if stock values rise, with favorable tax treatment on capital gains if holding period requirements are met. Non statutory stock options work similarly, but do not offer the same tax advantage, though taxes are often due upfront at the time of grant. Restricted stock grants executives discounted shares but limit their ability to sell them for a set period, usually 5 to 10 years, while offering delayed tax benefit until restriction expires. Phantom stock plans provide hypothetical shares that convert to real value upon retirement or after meeting conditions, helping executives benefit from stock growth while delaying tax to lower post retirement rates. Discount stock options grants shares at prices well below market value, giving executives immediate financial benefit. Stock appreciation rights let executives earn income based on stock value increases without needing to exercise stock options, with taxation generally deferred until retirement. Across these plans, companies benefit from tax deductions while aligning executive rewards with long term company performance. Collectively, these mechanisms encourage executive retention, performance, and investment in company success. Executive severance plans provide pay executives upon termination, usually negotiated at hiring with written contracts. Golden parachutes provide large payouts with tax benefits but face limits, while platinum parachutes add severance benefits and stock option to help companies avoid disputes or bad publicity. Companies offering these benefits must comply with federal regulation, including Department of Labor filings for top hat plans and IRS rules on deferred compensation. Disclosure of executive pay is regulated with the SEC, or Securities and Exchange Commission, with reforms in the 1990s aimed at clarifying reporting and holding boards accountable for excessive compensation. The Sarbanes-Oxley Act of 2002 further strengthened financial oversight after major corporate scandals, creating stricter disclosure and audit standards. Later, the Dodd-Frank Act of 2010 increased transparency by requiring shareholder say on pay votes on executive compensation packages. Through these votes are non-binding. Overall, severance plans must reward executives, limit company risk, and comply with changing rules.